tax special, and our guest today is Amarpal Chadha, a partner at People Advisory Services at EY. Thanks so much for joining us here on ET Now on the Money Show. It's the tax special, and some relief that came in for all the taxpayers with the government agreeing to extend the deadline for filing income tax returns by 30 days. So from 1st of September, there will be a penalty of 5,000 rupees. But we've been getting a lot of queries on if you file an ITR, it's wrongly filed, can it be amended, by when? But to not make such mistakes, what would you say is a good checklist to have in place? Supposing someone's not going to a chartered accountant or wants to be doubly sure the chartered accountant is doing it right.
Sure. So very clearly, if you're doing your own ITR or whether you're using a consultant to do your ITR, the responsibility is yours, it's your ITR. So very clearly what you should be keeping as documentation while completing your ITR. And let's take an example. If you're doing a simpler return where you have only salary and capital gains, I would definitely advise that you look at your Form 16, you look at your capital gains statement, your DMAT account statements. Have a look at your Form 26AS, which is a detail of all the TDS that has been deducted for you, which sort of provides you a reconciliation to look at. So look at all these documents and then see what is coming in your tax return. Only if all figures match, then you should file your tax return. Otherwise, you are preparing yourself for a notice from the tax authorities.
And before I go to the queries, can you just clarify for us, supposing a assessee misses the deadline, the new deadline of 31st August, what happens? What's the penalty?
So the penalty that has been levied is a fixed 5,000 rupees. It's a fee for delay in filing the tax return. This is a newly introduced section which came in last year and has seen amazing results, because if you see the number of returns this year which got filed before 31st July, the number is huge as compared to last year. So I think our tendency to react to fines continues very well. And if you don't do it by 31st August, then you definitely are liable to pay 5,000 rupees.
Okay, so 5,000 rupees is what you'll have to pay if you don't file your income tax return by 31st of August. And if you've got any confusion, if you're mixed up about something, have any queries, this is the show for all of you. You can send us your queries by Facebook, Twitter. Our phone lines are open as well. Now let's move on to the viewer queries, and I'll move on to the first one. We've got this via email from a viewer, R.V. Rao, who writes, soon after uploading my ITR1 and getting the acknowledgement number, I found a mistake in the filing, so I immediately filed a revised return and e-verified it. My question is, does my first return need to be e-verified as well? What would you tell the viewer, like what needs to be done or what does not need to be done?
Yeah, that's a good question, and a little technical difficulty on the fact that a person who's not used to doing this on its own, if you filed a return, please remember the return is only complete when it's verified. So, and you can verify it through electronic means. That is, you can use your Aadhaar number or a bank account number to e-verify your return, or you can send an acknowledgement to the tax authorities. But please remember, unless you do a verification, a pure uploading of a tax return does not make it complete. If you do not do the verification in 120 days, the return will become invalid. So to answer your question, since you've done 2 tax returns, you need to e-verify both of them. The first one which you filed, the second one which you revised, both need to be e-verified.
Okay, so I do hope that helps out, and Mr. Rao is able to understand what needs to be done. I'll move on to the next viewer query. Geeta has written in to us, I sold a commercial flat in 2017 at a price less than the circle rate due to an emergency. I then purchased the flat in 2007. Can you tell me how to calculate the long-term capital gains tax on the flat? So Amarpal, in real estate, there's of course that provision that if you reinvest the money, there's certain tax in another real estate project, then there's some tax breaks that are open, but there are also penalties if it is sold below circle rates, right?
Yeah, yeah. So, and that's a very valid problem because it is possible today that the market price may be actually lower than the circle value or the stamp value that is prevalent in a particular area. So I think this question is very, very valid and maybe very relevant for many of us who have properties where the actual price is less than the circle value. So what should you do if you have actually sold at a price which is lower than the circle value? There is a provision under the Income Tax Act which gives you a concession only for 5%. So if your value of the asset, for example, if the circle value is 105 and your asset value which was sold is 100, you are fine and you don't need to do anything. But if the variance is higher, actually the capital gains would be computed based on the stamp value and not on the real transaction value that you had. Having said that, if you feel that the difference is huge, genuinely the market value of the asset is lower, there are provisions under the Act through which you can approach the assessing officer for a valuation to be done again so that a fair price can be determined. But very technically, the Act provides only for a 5% levy. Anything beyond that would become taxation at the stamp value, not at the transaction value.
Okay. So I do hope that helps Geeta out. In fact, we've got another lady who's written to us, another female viewer, once again to do with real estate. Kavita Rajaguru says, I bought a property before marriage and was paying a home loan. After marriage, I quit my job and my husband is repaying my home loan. Can my husband claim housing loan interest rebate and deductions towards the housing loan? Amarpal, is that possible, and is there any rate differential also that exists? It does, which has been provided as an incentive, right, to get women to buy real estate.
Yeah, yeah. So interestingly, since in this particular fact pattern, the house property is in the name of the spouse, that is the lady here. If the repayment of the loan is now made by the husband, it is difficult for the husband to get a deduction, because if we look at the facts, the house property was bought by the wife. The asset stands in the name of the wife. The wife was repaying the loan earlier. Now, since all these factors very clearly prove that the ownership is with the wife, and if the husband starts repaying the loan, he would not be entitled for a deduction. So this needs to be planned well in case there is a plan that any of the person should be repaying. It may make sense to buy the property joint or have the registration joint. Otherwise, you will end up losing the deduction for the interest that is being paid.
I do hope that helps out the viewer, and I had a follow-on question. But before that, I do understand that we have a live caller from Hyderabad. Good evening. What's your query?
See, our family has sold one property. It is 50 years old property. We sold in December 2017. My question is, how much time do we have to invest in a capital gains account in a public sector bank? 6 months or 1 year? And another is, we have sold the property which has land and building. So 2001 base rate we have got for land. What will be the rate for construction cost?
Okay. So very clearly, see, there are the indexation is governed by the factor that you know. There is a capital gain indexation factor which is fixed every year. You need to use that both for land and building to compute, and you get 6 months to invest this money from the end of the financial year. So whatever gains that you have from the sale of the property that you can invest in bonds within 6 months, not 1 year.
Rajesh, does that answer all your questions?
No, like we have invested, we have put the money in a public sector bank in 7 months. So is there going to be any penalty or something?
So it's not public sector banks. It is very clearly some of the specified schemes and bonds, typically referred to as capital gain schemes, capital gain account schemes, where you have to put in these money and it has to be put within 6 months. If you don't do that, the capital gains will become taxable in your hands.
Okay. You know, with that, we have to take a short commercial break. Rajesh, I hope you are indeed satisfied. If you've got more queries, write in to us or call us again. Our phone lines are open. For now, we're going to take a short commercial break. You're watching The Money Show, the tax special. The deadline is looming large for filing your income tax returns, and we are your destination to help clear any clarification you need or any confusion that you may have. Stay tuned.